you for having us here.
Well, thank you for coming, and got hundreds of investors and a bunch of CEOs and others from companies giving their view of the future, so it's good that you can be here to help put some of that out in the public domain.
Okay, good. So let's talk about the view of the future. We got an inflation report, widely discussed this morning. 7th month in a row of cooling inflation, 6.4%. What's your assessment of how fast it can come down from here?
Well, I think the question is sort of the sticky or not sticky components and the different elements, but the reality is the labor markets are still strong, and you've heard Chair Powell and others talk about that because the reality is new claims for unemployment are low. There's a lot of talk about I'm not hiring as many people or I'm slow down my hiring. There are layoffs, but you still don't see a major adjustment in terms of unemployment rate. And that job tightness, wage tightness and things is something they've got to see, but it's flattened out. And then rent is the other big one. And rent sort of has a seasonal pattern to it. And you think about school changing in September, rent starts. So you usually have a kick up, and then you have rents come down, and they came down twice the percentage they usually fall in the latter part of the year, and they're down in January. So that's coming in line, but it'll be slow to get through. So as you look forward, our team has a recession predicted. They've moved it out another quarter recently to start in the third quarter, fourth quarter, first quarter next year. They've lessened the impact, and I think people are sort of coalescing on this idea that maybe this thing is not a soft landing, i.e. no recession, but maybe a more mild recession. And the delay is due to the strength of consumer and other things. But the Fed's going to have to get inflation where they want it, and that means they're going to hold rates higher. And that's the conundrum that's going around the market. But the big change was 0 to 5%.
Yep.
Yeah, the next incremental is not as big. And I think one of the Fed voters a long time ago described it to me. One of the great ones said, this is like we're climbing a rock wall. It was handhold to handhold at points like this. You're just looking for the data and see what's happening. Everybody thinks there's a grand scheme, but they really got to react. And right now the data is saying it's softening, but it's not tilted down yet to the level or flattened out. No,
but the market's all excited. 2 more hikes, then a pause, maybe even then some cuts. Is the market?
We don't have any cuts this year.
No cuts.
And I think you're going to have to make sure it's choked down because it's much higher than we've seen. I recently talked to a central bank head that's not a central bank head anymore. And he said we died to try to get inflation over 2%. And so the idea is to get it back to where their targets will take some time to make sure they manage it.
So as far as the economy is going, you said you moved out the recession call. Your team did. Consumer spending, you've got a good read on that. You said, I think 6 weeks ago, that January started strong. How has it been so far in early February, and what are you seeing now?
So if you take like the first quarter of 22 versus the first quarter of 21, the rate of increase was double digits, 14%, 12, 13% type of numbers. That's now in the fourth quarter of 22 versus the fourth quarter of 21 fallen to 5%. In January, it's picked back up a little bit. So year to date, 5-6%, which is very consistent with a 2% growth economy, very consistent with a low inflation economy. And that's what it was sort of in 17, 18, 19. It kind of ran at that level. So it's not going down anymore. It's not slowing down. It's actually year-to-year growth off of now a high base, and you actually look at it, it's solid. And so that means consumers are in pretty good shape. They have money in accounts. They have a capacity to borrow. They're employed, 3.5% unemployment rate plus or minus. The wage growth is still relatively strong. Inflation is tough on people who are the rate of goods is exceeding the wage growth, and that should come back in line as they choke it down. But overall, the consumer's in very good shape in America.
What about loan growth? Where are you seeing it strong, and where are you seeing it slow down?
Yeah, right now it's kind of bumping along because the economy is sort of flattened out in terms of expectation. Businesses are being careful. And so what do they borrow for? They borrow for to invest in people, invest in plant, invest in inventories, and all that. They're trying to make sure that they're right on that, and that's been interesting. So line usage has flattened out a little bit, but we have mid-single digits, and we're sort of consistent with that. But the overall market's sort of flattish in loans. This H8 data that comes out every week or so, you see it, but it's kind of bumping along now. And so we're seeing a little bit of growth in the commercial businesses, flatness in the consumer businesses, and then in the markets business, that goes up and goes down depending on what's going on.
What about housing, which has been hurt by the higher mortgage rates, but some signs of maybe stabilization there as mortgage rates have come off the highs?
Well, we were going along in housing. We got back after the financial crisis. It fell back to sort of the 3% long-term rates. Then it spiked after in the pandemic as everybody ran for different question. It fell first and then spiked back up, and now it's tipping back down. And so I think it's going to get back in a healthier balance. The rate structure move hits housing fast, and now you're since that started last summer, in earnest last year this time, you're now a year away from it. And so the first big moves in mortgages started slowing down housing. And now you're seeing a stability in sort of mortgage production. But it's down dramatically from where it was prior to the pandemic. And it should be. I mean, that's what the Fed's trying to do, is cool down housing.
Yeah.
It's a measure of wealth and it's a measure of inflation that they need to cool down. And they're doing that happens first because it's so rate sensitive.